Hi guys, it's Linda with New American Funding and the Steve Shower Lending Team. I get a lot of questions in regard to the temporary buy down options. And I want to go over with you guys today just to kind of briefly explain what it means. For more details, give me a call, 702-574-1877. I would be happy to dive in deep with you guys on this one. When we're looking at these options, there are a few of them. We have the 1-0 buy down, 2-1 buy downs, 1-1-1 buy down, 3-2-1 buy downs. Now, in my professional opinion, the 2-1 buy downs are going to be the best option unless we can get more credit to get that 3-2-1 buy down. One first thing you need to know about these numbers, that first number right here is going to be the first year. The first year of how much lower the interest rate is going to be when we locked you during the home purchase process. So first year on a 1-0 buy down, 1% lower. Second year goes back to the interest rate that we originally locked you in on. 2-1 buy down, first year, 2% lower. Second year, 1% lower. 3 to 30 years goes back to the interest rate that we initially locked you in on. Now, so you get the idea. 1-1-1, 3-2-1. First year, second year, third year, how much lower it is for the interest rate. I'm going to show you this chart right here on a 2-1 buy down and a 3-1 buy down. Well, Linda, I don't know how much to ask the listing agent or the sellers for credits to be able to use that amazing program that you're talking about. Well, let's talk about it. So this is going to be a hypothetical scenario. We are not basing this off of anybody's credit score, loan amount, LTV. This is just going to be used as an example so that you guys get an idea of how much to ask for and where that money actually goes. All right, if we're looking at a conventional loan, and we're going to go ahead and say 6%. So when they went into contract, we locked them in at a 6% interest rate. Now, the temporary buy downs are going to be different from adjustable rate mortgages and permanent buy downs. And we'll go into that in another video. If we're looking at a $350,000 purchase price, 5% down, that's going to make their loan amount $332,500. The first year, 2-1 buy down, year one, the interest rate is going to be 4%. Second year, the interest rate goes up to 5%. And then years 3 to 30 goes back to that interest rate we had initially locked them in on. Now, what the seller is essentially doing is when they offer these credits, they are giving them the funds to prepay their mortgage. 2% lower, 1% lower, then back normal. It's going to help them ease into the payment. And then when the rates get better, you can refinance that down the road. I'm going to show you guys a program that New American Funding has right now that does just that for free. So $350,000 purchase price, loan amount $332,500. The difference between a monthly payment on a 6% interest, okay, versus 2% lower is they're saving $406.10 a month, meaning that first year they are saving a total of $4,873.20. Second year, interest rate goes up 1%. We're easing them into it, goes up to 5%. The difference between these two payments are going to be $208.57 a month. Year two, $2,502.88 in savings. So you would need to ask the seller for at least $7,376.08 This gets held in escrow. The same escrow account that you're paying out the homeowner's insurance, property taxes. The sellers offer this credit at the time of the sale. This gets held in the escrow account and supplements those monthly payments, year 1, year 2, deducted from this amount out of escrow. I hope that makes sense. Now I'm going to show you what a 3-2-1 buy down looks like. I thought I ordered all this. Same loan, right? We want to keep continuity. 6% interest rate, $350,000 purchase price, 5% down. Everything kind of adjusts for me. Year 1, the interest rate is 3% lower. 3-2-1. First year, 3% lower. Second year, 2% lower. Third year, 1% lower. Years 4 through 30 goes back to the interest rate we had initially locked them in on. Kind of the same thing. The difference between year 1 and year 4, the payment is $591. Year savings of $7,100.07. Year 2, monthly saving of $406.10. Year 3, $208.57. Years 4 through 30 goes back to that monthly payment that they were locked in on. So in total, if the seller is willing to offer $14,476.14, that gets held into escrow, and they're essentially prepaying the mortgage for the client because we want to target pain points. What is the pain point? Why is everybody holding off on buying right now? Well, the interest rates are high. Sellers are having a more difficult time. There's more competition. It is flipping to a buyer's market right now. So guess what? They're offering credits. This, while it is very possible to get these credits, the 2-1 buy down, that's why I'm saying it's the most readily available. It's not breaking the bank. You have a lot more negotiating power. And guess what? Interest rates are anticipated to drop into the 5s next year. When that's going to happen, they're anticipating early to mid 2023. Nobody really has the exact crystal ball on that, but it is possible. Now, New American Funding has a 5-year rate protection pledge. So let's say, for example, we are able to get you for the 2-1 buy down, sellers are willing to offer those credits. The 5-year protection pledge just means that New American Funding, you close your loan in 2022, we're going to pay for your refinance. We're going to do your refinance for free and pay for the appraisal for the next 5 years. So if you lock in your refinance by December 31st, 2022, meaning you've got to close a loan by the end of 2022, you'll be eligible, and there's nothing extra that you have to do. You're already in this program until December 31st, 2027. And like I said, we are going to pay for your appraisal and waive the lender fee. So if the rates are what is holding you back from purchasing a home, we have a solution for that. We have a way around that. And if it makes sense for you and your family to just buy the home, marry the home, date the rate, because we're going to refinance you out of that higher interest rate. And well, the question is, Linda, what happens if I do the 3-2-1 buy down, but after year 2, I refinance? What happens to the rest of the money in escrow? Well, that gets credited back to you during the refinance. You don't lose this. This goes back to you. So it's a win-win. There's no losing. Now, If you guys have any other questions, I just wanted to touch on that briefly. Give me a call, 702-574-1877. I just wanted to kind of give you that scratch on the surface, explaining exactly how that works. We'll talk to you guys soon. Have a wonderful day.